Hello, everyone, and welcome to this session, Customer-Based Corporate Valuation Primer. This is Jose Carlos Alcázar, and I'm the founder of Campus Financiero. And I'm very excited to introduce you to our speakers today, Peter Father and Daniel McCarthy. Peter was my professor 10 years ago at Wharton. He is the Frances and Pei Yuan Chia Professor of Marketing at the Wharton School and co-founder of Theta Equity Partners. He's an expert on the analysis of behavioral data to understand and forecast customer shopping purchasing activities. He works with firms from a wide range of industries focusing on topics such as customer relationship management, lifetime value of customer, and sales forecasting of new products. Daniel is Professor of Marketing of Emory University's Goizueta School of Business and also co-founder of Theta Equity Partners. Daniel specializes in the application of leading-edge statistical methodology to contemporary empirical marketing problems. His research interests include customer lifetime value, limited data problems, and the marketing finance interface. And he has popularized the customer-based corporate valuation. I want to thank both of them, together with Joshua Bernstein from Theta Equity Partners, for making this webinar possible. This webinar will be recorded. If you have any questions during the webinar, feel free to use the Q&A that you have at the bottom of your screen, and the speakers will be answering your questions at the end of the session. Thank you very much, Peter.
Thank you, Jose, and good evening, everyone. It's just so great to see people taking the time to want to hear about, talk about, learn about this idea of customer-based corporate valuation. I'm going to share my screen right now and dive right into the details, get into our slide deck. I hope that you can all see the slides here, and you'll see this is very much a collaboration between Dan McCarthy and myself, work that we're very excited about. Now, you might wonder, how is it that two marketing professors, and you heard all the things that Jose said about us, what would we have to say about valuation? Well, the fact is we have a lot to say about valuation, but we come at it from a very different direction than the way that valuation is usually discussed and taught in finance courses. Specifically, we come at it from the bottom up as opposed to the top down. If you think about the way valuation works, again, the way that it works in practice, the way that it's written about in textbooks, the way that it's taught in courses, it's usually from the top down. Usually we look at a company, we say, wow, they have some amazing assets, they have great operations, they have terrific management, really good employees. And we tend to look at the company very holistically. We look down at all the operating assets and say, yeah, this is pretty good. This is going to give this company a good runway in terms of revenue, cash flow, growth for years ahead. But if you think about all of those sources of value that I just mentioned, and that, again, most people on Wall Street tend to look at, they overlook this one source of value over here, the customers. And our basic point is that we can take our marketing models, the kinds of things that I've been doing as a Wharton professor for 30 plus years now, projecting how many customers are we going to acquire? How long are they going to stay with us? How many transactions will they make while they're still having a relationship with us? What items will they put in their basket? How much will they spend? How much margin will we make off of each of them? These are questions that are usually asked and answered purely in the domain of marketing. But our point is that if we look at them from the big picture, basically this is underlying all sources of revenue. So to look at any operating asset, it is absolutely worthless unless it is helping us acquire more customers who stay for a longer period of time, who do more, who spend more, maybe lowering the cost on each of those things as well. And of course, there's a bunch of accounting and finance stuff as well. It's not enough just to run these marketing type models and kind of adding them all up. It's very important to be fully aware of, respectful of all of the different aspects of capital structure, non-operating assets, fixed costs, and all the other things. In some sense, that's easy. That is what the textbooks are telling us. We're just coming up with a different way of projecting the cash flow in the first place, from the bottom up. I hope that makes sense to you, because as Dan and I lay it out to a lot of people, they go, yeah, you know, that does make sense. Either I've never thought about that before, or yeah, we kind of try to do that, but we've never quite gotten our arms around it. Or it's something that we do just on the side, but we're too busy just projecting the cash flow in an ordinary top-down way. We are trying to revolutionize finance by having people embrace these ideas and making them front and center in any kind of evaluation exercise. What Dan and I are going to do is we're going to take you to two case studies over here. I'm going to focus on a public company, actually one over in Europe, Farfetch, an online luxury marketplace, some of you might be familiar with. And then Dan is going to do an analysis on a private company, one that we've done through the auspices of our startup, Theta Equity Partners, to give you just a better sense of that's kind of more of what we do on a day-to-day basis. But I think you're going to enjoy this Farfetch example over here. See, what happens is a lot of companies, when they announce their IPO, they put out there their S1 filing, or in this case, as it is a European-based company, their F1 filing, that provides some metrics that help investors get some understanding of what that company is all about and how good an investment it would be. But I think it's fair to say that rarely do people look at those kinds of metrics through the lens of valuation and more about, oh, this company just has, you know, good-looking data. Let me give you a specific example. So here's a company that announced its IPO in late September of 2018. In their F1 filing that came out several weeks earlier, they put out a bunch of different disclosures. Now, you're going to look at these disclosures, and I hope that you're going to find them entirely uninteresting. These are the kinds of things that I believe every company should be revealing to its shareholders, and not only when they go public, but I believe they should be doing this on an ongoing basis. Every quarter, they should be revealing metrics like these, or investors should be demanding these kinds of metrics. Like, for instance, you know, how many customers were active with us, made a purchase with us in each of the last 3 years, and how many total orders were placed. And sometimes they'll provide charts like these. You all know about the good old LTV to CAC ratio. And while on one hand, I kind of like this notion, I like the idea that we actually are thinking about some idea of customer lifetime value when we're making these investment decisions, I'm also really concerned, like in a case like this one, when what they're calling LTV is purely historical profitability. Well, that's not right. If we're really talking about lifetime value, yeah, sure, we want to look at the historical data, but you also want to project it forward to say, well, here we go again. How long are these customers going to stay with us? How often are they going to transact? How much will they spend? So these are the LTV to CAC ratios. These are literally taken right from their F1 filing. We're going to show you the right one. Instead of the numbers that you see over here for the 2016 cohort of a 2x ratio between LTV and CAC, we'll show you the right way when we take this kind of data and project it forward. But first, there's one other disclosure, one that Dan and I find very, very interesting. It's what we call the C3, the customer cohort chart. And I bet a lot of you have seen data kind of like this, where we look at each cohort and we see how they're growing or shrinking over time. Now, the way that Farfetch showed it is kind of weird. If you look at this big red band, that's not a given cohort. That's probably what you're thinking it is. That's just the amount of overall revenue they're getting from, in each case, the newest cohort. So this is not quite the right way to show it. I'll show it to you the right way on the very next slide. But you've seen something like this chart where you see not only the overall growth in revenue for the company, but decomposing it into these separate cohorts. To us, that's critical. And we want to augment it with some of the other kinds of measures that you see on the left, and even some other measures that you're going to see coming up as well. So I want to emphasize that we're not just fitting curves to the data. We're not just saying, can we come up with a line that's going to capture these figures as well as possible? No. Because we're marketers. We're storytellers. We're going to tell a story about what's going on below the surface of the data. In fact, that's where the action is, to show you things about customer retention and so on, even though that's not directly revealed in any of these charts or graphs. So let me first show you. If you look at the top row over here on this next slide, this is their data, okay? The top left would be that C3 chart once again. And we tell this very principled story. We're building the same models that we'd be building regardless of what kind of data we get about how many customers you're going to acquire, and how long they're going to stay, and how often they're going to transact, all that. Top left is basically our restatement of their picture. That's just the actual data, but shown to you on a cohort by cohort basis, the way you'd want to see it. In the lower left, you see how well our model fits to it. And it's pretty remarkable. Not only how well it fits, but keeping in mind that, again, this is not a curve fitting task. We're building this very principled story about how long customers are going to stay, what they're going to do over that horizon. We're not coming up with a bespoke model just to give us the best possible fit to the graph at the top left. We're telling our story. We're telling the same story we would tell even if we didn't see any data at all. And then we're just taking whatever data we can to try to bring that story to life. And it seems to come to life pretty well. So in the bottom left, you see how well it fits the C3, the customer cohort chart. If you look on the right, you can see how well we fit the other two metrics that I showed you at the top of the previous slide. Now, while this by itself doesn't prove to you that the model's right, it does give you a pretty good sense that we're capturing everything worth capturing. And in fact, I want to go a step further than that, because it turns out that in their F1 filing, Farfetch revealed some other data. It was basically buried in some of the text. It wasn't a standalone separate chart. But we built our model on all of the data that I just showed you. And they said, oh, by the way, we have these three other data points. We didn't use them to build the model, but let's see how well the model picks them up. So for instance, in the text, Farfetch said that they had acquired over 240,000 customers through the end of 2013. And what's our model estimate? Well, you can see that on the chart right over here, 248,000. Looks pretty good, especially considering that we didn't use that data at all. Secondly, they just announced, just in passing, they acquired their millionth customer in 2016. And according to our model, we said, yeah, that should have happened in June of 2016. And here's a third one, that they say that as of June 2018, that they had acquired over 2.3 million customers. And what does our model tell us? 2.4 million. No cheating, no funny business, no game playing, nothing that's really uniquely customized to this particular data set. It's the same exact model that we built for many, many other companies, public and private. And it gives you that good feeling that we're capturing the stuff you really want to know. So that's great. So let's talk a little bit about the unit economics, because that's what we really feast on. Our ability to get below the surface of all the aggregate data and make statements about the profitability of specific customers. So this is a really interesting chart right here. Once again, Farfetch didn't reveal anything directly about how often a customer continues to transact with the company after they're acquired. But by building our very principled model, the same kind of model we built if we had all of the raw transaction log data, we can infer what that shakeout looks like. We can infer what % of customers will still, I'm not saying they're necessarily making purchases, but will at least contemplate making a purchase, that they at least still have Farfetch in their mind and they're thinking about whether to make one or more purchases. And so to be able to get a curve like this, that's just great. And then what we're going to do in the next couple of slides is then project it out beyond the period of the data that they provided into the future to come up with our overall valuation estimate. We can make statements about how much stuff they're buying when they buy. And again, it wasn't directly revealed in the data. The data gave us just enough information to peel apart these different aspects of customer behavior. And so far, this shows a pretty good picture. It shows that the basket sizes are increasing. That's great. And if we tie it all together, we find out that the post-acquisition value, but this isn't just in terms of observed data. Now we're projecting out infinitely far. Let's project this out way into the future, discounting back using an appropriate discount rate, related to the weighted average cost of capital, to say what's the value of those future dollars. And what do we see over here? Well, it's very, very interesting because we find out that the lifetime value, the genuine lifetime value of these far-fetched customers is very, very high. That customers are staying around for a long time. They're making frequent transactions, and they're spending a lot when they do. So we're finding a lifetime value on average of about $1,000 after acquisition. Of course, there's tremendous range of that. There's plenty of customers who buy once and go away, and other customers who stick around for a long time. And we're able to uncover all of that and show what that distribution looks like. And then once we can now back out the CAC part too, the cost of acquiring a customer, and we find out this is also a very good picture, that they're spending on average about $100 for customer acquisition, and unlike most companies we look at, it's actually flat to going down, which is great. So when you combine the two pieces, these two really important takeaways of this slide, we find out that LTV to CAC ratio is more like 10x, not just the 2x, that they're telling their own prospective investors. It's just crazy to me that a company would actually be undervaluing its customer assets and putting out a ratio that is actually too modest. So I hope you get the idea here that by going beyond the data, going into the future, and with a model that seems to capture the essential parts, we can make more accurate statements about what a company is actually worth. So let's piece together all of it right here. Let's take the very same set of analyses that we did, but instead of stopping at the time of the IPO in late 2018, let's project ahead. Let's project how many customers will we acquire. Let's project how long will they stay with us. Let's project how many orders will they make and how much will they spend when they do. So if again, you can see the curves that I showed before basically stopped at the orange vertical line, but they were working so well, so why should we just stop with the present and the past? Why don't we go into the future? And when we do all that, that gives us the ability to project overall revenue. And when we do all that, that gives us the ability to project overall valuation. I hope that makes sense. Of course, we'll be very glad to give you other examples beyond the one that Dan will share with you, and take your questions about it too when we get to the end over here. So basically, right after they put their numbers out there in the F1, we did the kind of analysis that I showed. And of course, there's much more details available about it on the Theta Equity website. And we basically said, this company's worth about $20 a share. And you can see it all for yourself right here. If you look at what was going on, when they first announced the IPO, the buzz on the street was that the company was worth around $15 to $17. They actually opened, they kind of announced their target price of 20, and then on day one, boom, it popped. It went up over 50%. And we thought, well, on one hand, this is great. It proves that the original valuation they had in mind was too low, but at the same time, it might have been a bit too high. And you can see a piece from Dan here in a big American media source, CNBC, basically saying, well, we think the company's good, but not that good. But of course, very often what we see just on the day of, the day after the IPO, isn't necessarily typical of what we're going to see for the firm over the long run. And sure enough, over the weeks that followed, after this big pop around $30 at the time of the IPO, you can see that they settled down closer to our target price of $20 with lots of volatility. That was actually one of the things that we noticed in the analysis, that there's actually much more volatility, much more uncertainty for this company than there is for other companies that we've looked at. And then what happened last September? Oh my goodness, check it out. Boom. Last September, they announced their Q2 earnings and the company hit the bottom. The stock dropped 40% in a day and kept falling after that. This is a big problem. A lot of people came to us and said, well, what happened to your $20 target price? Well, good question. So the nice thing about these models is that it gives us the ability to diagnose, to do this kind of forensic analysis, say what was happening with the company. And by the way, with the whole COVID crisis going on right now, It is exactly this kind of analysis to understand the impact that COVID is having on your business. Is COVID keeping you from acquiring customers? Are they leaving more quickly? Are they spending less often? Are they spending less when they do? So being able to take a company's revenues and break it down into these factors and really understand where the pain points are, whether it's because of a bad earnings call, as Farfetch had a few months ago, or because of some kind of external crisis. This shows you the real value of customer-based corporate valuation. Anyway, we looked back at our model and said, what were our forecasts for each of the different key behaviors? And we found out that for things like the number of active customers, the model was right on. In other words, it's not that they had fewer customers doing things with them, so where was the problem? And here it was deteriorating margins. In other words, it was the fourth question. How much do they spend when they do? And for various reasons, we don't know better than anyone else. We're just on the outside looking in. We're just looking at the publicly traded data. Their margins were shrinking. Maybe it's because of greater competition. Maybe it's because of some change in management strategy. We're not 100% sure. But what we could tell is that the main driver of that drop that you saw was because of margins, not necessarily because of customers' willingness to do things with the company. So we revised our analysis, and again, you can read all about it on the Theta website. And basically, in September of 2019, we said, you know what? With the margins that they have going on now, the $20 target price isn't quite appropriate anymore. Should be more like $14 a share. Again, with still a great deal of sensitivity, still a lot of volatility around that. If you're interested, there's a link to the updated analysis. And let's see what's happened since then. This is very, very interesting. So you can see in the middle of the chart here, that's the big drop in 2019 in September. And you can see the stock price dropping for most of the rest of the year. And we're saying that is not a good representation of this company. The company is worth more. We said back then they're worth closer to $14 a share. And sure enough, where did they close yesterday? Just over 15. So we have to be very careful about picking stock prices. There's a lot of reasons why stock prices go up and down above and beyond changes in their cash flow. So we want to be careful, and we shouldn't be too boastful about it. But the very fact that we saw something in this company that other investors didn't see, so in other words, suggestions that there's actually still a lot of good unit economics here. There's still a lot of health to their revenue and cash flow, and that investors overreacted back in September. That's the whole point of CBCV. One last point before I pass things over to Dan. Recognizing some of the volatility, recognizing some of the sensitivity, this desire to play what-if games. What if we acquired customers at a faster rate? What if we lost them at a slower rate? So one of the things that we developed because of this Farfetch analysis is what we call our CBCV simulator. And if you're interested, you could go in there and play with it for yourself, specifically in the case of Farfetch. And this has become so popular that a lot of companies, whether it's individual corporations or investors, have come to us to say, hey, we'd like you to build that simulator for us or for one of our portfolio companies. Once again, to understand what the company could be worth under a variety of different scenarios and to understand where the greatest pain points and sensitivities are. So that's our analysis of a publicly traded company. I'm going to stop sharing over here. I'm going to hand things off to Dan and let him pick it up from here on the private side. Dan?
All right. Hello, everybody. So I'm just going to share my screen now after pulling it up. 1 second. Okay. There we go. Hopefully everyone can see me. Yes, as Pete said, that's a pretty representative example of the sort of analyses that we'll do when we're working with public companies. When we're moving to private companies, first off, this is the setting that's probably the most commonly used for us as a firm at Theta Equity Partners. We've probably done, depending on how you count it, 6 to 8 kind of rigorous public company analyses. We've probably done 60 to 70 private company analyses. So again, it's just kind of the more common use case for us. And as Pete had alluded to, one of the big things that we gain when we're working with private companies is we get to see all of the granular transactional data. And so it allows us to do a lot more validation. It allows us to make a lot more many more granular statements about how the customers are doing, where the value is coming from, than we could ever hope to with the public companies. So it's not to say that with the public companies, the models are bad. In fact, the overall predictions that we can make in those public company settings, when we do see the sort of data that companies like Farfetch provide, we can do a very good job of making those predictions of the future cash flows. But we can tell a much richer story, building on that storytelling that Pete was mentioning, when we do have all of the granular data. So this example, it's a pretty representative one of the private company analyses. So it's a retailer. Due to non-disclosure, we can't say the nature of the retail, but you could think of them as a company that is a combination of bricks and clicks. They've got physical storefronts and they've got their website. They operated across the country in the US, and they're a mid-sized company. So we have about 5 years plus of granular transaction data. We've got all their CRM data as well. So in addition to their purchase behavior, we have other things about the customers themselves. And what we're going to do is build a model that's very similar to the model that Pete had described. So essentially, the underlying modeling is always going to be the same. We've got a model for acquisition, a model for how customers are retained, how they order, and how they spend. But when we have granular transactional data, the other thing that we can do is we can actually build separate models for each and every acquisition cohort. So basically, we're going to do that. And then we're going to validate it and then move into the sort of things that we can learn about the underlying health of this business that we weren't able to do with Farfetch. So just before even diving into the models, just a couple quick charts just to get a sense for the data. So again, a big thing about how we look at a company is we want to size up how they're doing in terms of things like acquisition and retention. So this is just to give a sense for how the company's been acquiring customers. And as we can see, they've been acquiring customers fairly steadily over the past handful of years with some seasonality. Now, obviously, a big thing about our approach is we don't necessarily care if a company is acquiring a lot of customers if they don't have very good retention and value when they make purchases. So let's dive into that second piece of it. So what we're looking at here is we're saying over different slices of time, let's take all of the, you could think of it as contribution profitability that we earned in that slice of time, and then just divvy it up between customers who are making their very first purchase and everyone who had already previously been with the firm. And so what we can see here is kind of over time, over this fairly long window, about 75% of all the profit that the company is making is coming from people who had existing relationships with the firm. That's, in general, for this category, a reasonably good level. And what it's indicative of is stability, that a lot of the revenue is coming from people, they know the brand, they're loyal already, and it implies that the company is not overly reliant on acquiring new customers just to maintain their revenue. So we feel pretty good about that, but obviously the big thing that we want to do is move beyond kind of heuristics and actually build some proper statistical models. So again, we're going to do the same sort of modeling and validation that we had done in the public company example we just described. We can actually do the validations at a much deeper level here because, again, we have all of that rich transactional data. So I'm going to start actually with the two charts on the right over here. What we're looking at is basically all of the purchases week by week that were made by a particular acquisition cohort. So these were all the customers that made their very first purchase in the second quarter of calendar 2017. And what we want to do is take that data and then project into the future how many purchases these customers will make over the ensuing one-year period. Now, this is probably the most challenging cohort that we can do an analysis for. We literally only have something like 3 months worth of data, and we're then projecting out for the next 12 months. When we have other cohorts that are older, we're able to make projections that are very accurate for young cohorts through the approach that we've taken, basically learning everything that we can about those old cohorts to infer exactly what we should expect. And here, again, we can see that that prediction ended up being very good. And so as we move from the two charts on the right to the two charts on the left, basically what we're doing is, instead of focusing on one single acquisition cohort, we're going to sum up all of the repeat purchase behavior across all of the acquisition cohorts. And so what this is saying in the top left is how many repeat purchases would we expect from all of the customers in the past and then into the future? And then when we take the cumulative sum of that, which is what we see on the bottom left over here, how does that look? So what is the total number of repeat purchases from the beginning of commercial operations up to different points of time? And again, we can see we're kind of bang on, not only for single acquisition cohorts, but also when we roll it up to the level of the firm. So again, kind of like when we were looking at Farfetch, we're first going to validate our model. We want to make sure that our model meets all of these different validation checks. We've got a series of 5 of them that we'll commonly use in this setting. Once we feel that the model is sufficiently validated, we're going to move to all of the things that the model suggests about the health of the company. So that's what we're going to do next. So the first thing that we're going to do is, as with Farfetch, we're going to look at the goodness of the customers. So this is, again, the post-acquisition value of customers on average by acquisition cohort. So it's just looking forward, what's the net present value of all the future profits before we take into account how much we spent to acquire the customers in the first place. And what we can see is, in this particular case, it's bang very, very steady. That the value of the customers has been about $265 US for about 6 years in a row. And so again, as we kind of move into the future, we're going to make this expectation of how good customers acquired in 2019 and beyond are. We can feel pretty good that in general, it's going to hover around that same sort of a level. Next, we want to bring in how much we spent to acquire the customers. So we know that we're making about, call it $267, $270 after they've been acquired. What this shows us is they're only spending $32 to $35 to acquire the customers in the first place. And so they're earning this return on their marketing investment of, call it 650% plus, which is really quite good. A lot of companies in this sort of category, you'd hope to get something like a 100 to 200% return. That would be really good. So 600%, it almost implies that maybe this company is leaving money on the table because they're not more aggressively acquiring customers through other channels that may be more expensive, but are still extremely profitable. So again, this makes us feel pretty good about the underlying health of this business. Next, we're going to turn away from how much they spent to acquire the customers, and instead we're going to try and explain the post-acquisition goodness of those customers. But instead of doing that calculus as a function of things like demographics, which is what most people tend to obsess over, we're instead going to look at the actual activity of these customers. We found what people do to be much more informative about what they will do in the future than, say, where they're from or other features such as their income level. So in this chart on the left, what we're seeing is basically the average post-acquisition value of customers by the first product category that they purchased. Now again, as you can remember from the previous slide, the average customer is worth about $267, $270 bucks. But what we can see from this chart is there's a number of products where if the customer purchased that product, they're actually be worth a lot more. And then there's a handful of other products where they're going to be worth a lot less. And so this may lead us to want to emphasize the merchandising of products like product number 1 and put those products higher up on our website and de-emphasize the products like product number 8, product number 10. Now, obviously, that is a static snapshot where we're taking every customer across the acquisition cohorts. What we're doing on the chart on the right is we're saying, let's look at that same kind of post-acquisition value goodness as a function of the product category, but let's look at the motion picture over time and look at, say, of the customers that I acquired in 2017, 2018, how good were those customers by product category? And what we can see is, say, if we were just to focus on product number 1, that dark blue line, we can see those customers have actually been getting better over time. And so again, as we move forward into 2019 and beyond, this would give us even more confidence that we'd want to emphasize products like product number 1. And then the final thing I'm going to talk through is just another way that we can slice and dice the behavior of those customers at the time that they first engaged with the firm. So over here, we're not looking at product category. Instead, we're looking at the actual place that they visited to make that first purchase. Did they do it in a store or did they do it online? And as we can see from the chart on the left, when those customers made purchases in store for the very first purchase, they tended to be worth a whole heck of a lot more valuable than the customers who made their very first purchase on the website. And the chart on the right, again, we move from the static snapshot to the rolling motion picture. We can see that that stability of value for those in-store customers has remained steady, while the online customers have actually been getting less valuable. So again, very important information for people who are making decisions about, do I open stores? Where do I open them? You know, should that be a part of my, should that be an important part of my strategy? And the answer in this case would certainly be yes. So I'm gonna just kind of open these up, and obviously we wanted to leave some time for questions. So I guess maybe just to kind of summarize, you know, for one, we really, as Peter said, we want to revolutionize how finance is being done. And the way that we're doing it is by incorporating this granular customer level activity that's typically ignored. And instead we're saying, let's take the best in class marketing science models that we have and use those to make the predictions of what the customers will do, and have that inform that same traditional financial valuation model that you've come to know and love. So, you know, we've already seen a lot of uptake within, say, growth private equity and other private equity. We're seeing a growing number of people realize the informativeness and usefulness of these models in public company settings. And we really hope that this becomes a standard that all analysts and other financial professionals will be looking to as they perform corporate valuation, either on their own firms or on firms that they're potentially considering an investment in. So that is all that I had, and I hope, yeah, this leaves us with a good amount of time to open it up to some questions. All right. Let's see over here. So I've got a couple questions that came through in the Q&A. The first one, what do you think about companies that are more focused on profitability rather than attracting a higher number of customers? I'd say this is exactly what customer-based corporate valuation was designed to help with. Over the past couple of years, if there's a big difference in the sort of companies that have been going and hitting the public markets relative to call it 5-10 years ago, it was that more companies are coming to market with very, very high growth but big losses. And so the question is, you know, which of those companies are actually valuable and which of those are not? And what we would say is, obviously we want to move beyond the growth, you know, whether it's growth in the top line, even growth in the number of customers acquired. And we want to look at the durability of the relationships of those customers with these companies. And again, we don't even want to just focus on the durability and longevity of those relationships. We want to also incorporate how profitable those relationships are, like how much variable profitability is Farfetch getting from these customers that it's acquiring. So it draws this important distinction between kind of the overall profitability of the firm, which, again, at the time of our analysis for Farfetch, you know, the company was not profitable. It's still not profitable. But what we're saying is a little bit different. We're saying when they acquire that incremental customer, are they turning a marginal profit on that customer? And the answer was decidedly yes. And what that tells you is that there is a path to profitability if the customer continues along its growth trajectory. We've looked at a number of other companies where that's not necessarily the case, where they're not earning, you know, 9-10x their money. Instead, they're actually losing money. They're spending a lot of money on marketing, but they're acquiring these customers. They don't do a whole lot with the firm, don't bring a lot of profit to them after they've been acquired. And when that's the case, that firm will never be able to grow out of that problem. You know, a higher number of customers may actually destroy value. And there's been a number of notable examples like MoviePass where that's been the case. So that's exactly what these models are designed to do. And then another question about the first case, how do you determine the model parameters and how to incorporate their instability over time? That's a very good question. So again, you know, we're basically using kind of best-in-class models from the marketing science literature. In fact, the plain vanilla models that essentially what we're doing at Theta are built on, we'd be very happy to share the academic work that goes through model estimation for them. So essentially, the short version is you've got all of this data that you can observe. Now, if you give me a set of model parameters, I can give you what I would expect all of that data to look like. And so essentially what the model estimation phase is going to do is it's going to find a set of parameters that make the expected data as close as possible to the actual data. So hopefully that general kind of modeling approach makes sense. In terms of how it all comes to life, in terms of the details, please shoot us an email. We'd be very happy to refer you to some of that work. Instability. So that's certainly an important part of obviously evaluation, because you not only want to know how much your company's worth, but you want to know, even if I was to incorporate the fact that I'm not quite sure what they're going to do, that I still feel like the company is a bargain. And especially in one of the academic papers that we'd be very happy to share, we actually explicitly address that we incorporate kind of uncertainty in our model estimates and use that to form not only just a valuation point estimate, like $14 a share, but an entire valuation distribution. So, even in the worst case scenario, this is how much we would think the firm is worth. I got another handful of questions coming in. Your model seems to revolve a lot around idiosyncratic risk, which traditional financial valuation models seem to not. Given this, isn't this model more exposed to risky events such as company shortcomings or competitors' hype? Well, I would posit that the CBCV framework has to be true. Revenue, profit, so free cash flow has to determine the going concern valuation of a firm. Revenue helps to determine what those free cash flows are. Every traditional valuation model, as long as it's not a valuation based off of book value, it's going to be based on some sort of revenue forecast. And the main humble claim that we're making is all that revenue has to come from customers. Either they're customers that had been acquired before and they're making new purchases, or they're new customers that just came in for the first time. So there's this additional information that we can glean by really taking all of that signal from the transactional data and use that to inform the revenue forecast. So I'm not sure I think that our methodology is more exposed to risk. I think this has to be the truth. We may model it poorly, but everyone is basically making the same sort of assumptions. We're just choosing to accept and fully embrace the fact that the revenues are coming from customers, whereas I think a lot of other valuation professionals, they kind of stick their head in the sand. They basically just ignore the customers. All right, thank you very much for the great presentation. Really interesting, insightful. Thank you very much. For what types of industries is this methodology better suited? This is a very good question. So there's certain industries where this will be more or less applicable, and even not applicable at all. The main thing that we need is we need to be able to tag and track individual customers over time. So Pete had mentioned Zodiac at the very, very beginning of this presentation. Zodiac was acquired by Nike in March of 2018. Now, if you just think about that example, Nike 30 years ago sold almost all of their product through distribution partners. So they never actually got to see what individual customers were doing. The reason that they acquired Zodiac a couple of years ago was because now they've got this 30% of their business that is direct to the consumer, and they see that growing significantly. And it has been growing significantly over the past handful of years. So that's the key. If you have a business where you're only operating through distribution partners, it can be hard to use these methodologies. So companies like Procter & Gamble, they just don't have that end user visibility, or they may want to use these methods, but they'd have to work through kind of proxy alternative data sources that do give them that individual customer level visibility. So energy, typically not so much. If it is oil and gas, you could use these sort of methodologies on the oil, basically on the individual oil assets, where we kind of model out the depletion curve of particular oil wells. In real estate, we typically won't see this being used. In finance, you can use these sort of methodologies, but the fundamental unit of analysis is probably going to be the individual loan and looking at the unit economics of that loan. But again, I think the same sort of methodology could apply. In areas like retail, hospitality, travel, pharmaceutical, typically any non-subscription setting, these would be very useful. And then obviously, it's like shooting fish in a barrel when we move into the subscription setting. And so this would be everything from telecom firms to life insurance policies, to the whole subscription box movement. Those would all be very easy to do the modeling for, because there we even get to directly observe when customers churn, which we don't get to in a non-subscription setting. Next question. Do you think that it's possible that extreme situations like the ones we're going through now change consumers' behavior and the effectiveness of your approach? So certainly, if you had run our model in February 2020, we would not have predicted COVID. No one would have predicted COVID. So really, the way I think about it is our approach can be incrementally valuable. It won't necessarily always provide the correct view of the future, but your traditional approach wouldn't have either. So I think that this methodology, it could be extremely beneficial. And so I think that's the kind of the relative answer that I'd give to that question. Now that we've seen the effect of COVID start to percolate its way through, we can actually be able to say, what it's affecting is acquisition, or what it's affecting is how younger, less loyal customers are making purchases with the brand, but not the older ones. And so we can start to be more diagnostic about what we expect to happen in the future, because we can say, well, we expect acquisitions to do this. We can see that loyal customers are still coming back, so we can still rely on them, et cetera, et cetera. But yeah, the emphasis is on incrementality. It's not necessarily on always being perfect. I think anyone who says that they're always perfect is selling you a false bill of goods. For online e-commerce businesses, this is a wonderful industry for this sort of methodology. How can they assess whether to open retail physical stores or maintain its core activity of selling online through the customer analysis? Should you open them first and then assess it? That's been the traditional way that we've been helpful. So we had a couple of analyses that we've run where they were firms, they had opened, call it 10 stores at that point. And they had obviously a traditional online presence. And what they wanted to know was whether and how much or even where should they open their next stores. And so they were raising a big round of capital, and the private equity firm that we were doing the analysis on behalf of was saying, should they raise this capital to build out all these stores? And that's a big risk for a PE firm. Maybe if they made all their profit off the online customers and the store customers weren't that good, that this would not be a good use of funds. And what we confirmed through that analysis was actually opening stores was very useful. But the fact that we could rely on the granular customer behavior for those first 10 stores was quite important. So that would be very useful to have. If a company that is publicly traded acquires another company that is private and it's not traded, how would you incorporate these new customers into your model? Wonderful question. The short answer is basically it's going to increase the number of customers that the firm has. And then we want to allow for the fact that the customers of the acquired firm could be fundamentally different, better or worse, than the customers that the company previously had. And so basically we would probably insert a covariate that says during the period of the acquisition, there's going to be this spike in the number of acquired customers to allow all those new customers into the firm. And then we're also going to say, I'm also going to allow for the fact that the retention and ordering propensities of all of these customers will now be different in the future. So will we know exactly how good or bad those customers will be right at the time of the acquisition? No, but we can very quickly adapt to that over the course of the next 6 to 12 months. How does the model adapt to different cycles of the market, bearish versus bullish? It's a great question. We've actually, if you go back to one of our previous academic papers where we kind of lay out the CBCV methodology for subscription firms, we included a couple of examples, one of which basically in the middle of the data set was the Great Recession. And what we saw there was basically that customers were not being acquired as quickly during the period of the recession, and existing customers had a much higher propensity to churn. We didn't see much any effect on how much was spent during periods that customers were alive. But it's kind of as you'd expect. You have a big economic shock. People are going to be less inclined to acquire for the first time. People who have money issues are going to be more likely to leave the firm. And so, essentially, it's somewhat similar to that last question about the acquisition, except here we're saying we're just going to introduce covariates that allow customers to behave differently during that period of time. And again, it might take 6 months for the dust to settle before we can have a confident view as to this is the effect that the market cycle's having. Once we've worked that in, then we can fall back on kind of the historical duration of, say, a recession to be able to play scenario analysis and say, well, if the recession is like the average recession, we'd expect it to last until here, and then we're going to move back into more normal times, and then we can kind of shut that covariate off. Or if it's going to be a severe recession, we can assume that it's going to extend much longer. But again, the overall framework is going to be correct. The question is how we should go about making that assumption about the market cycle. To what extent do you think this is useful for long-term investing? Fully understand the value of having a more advanced customer behavior model and having an above-average understanding of the next quarter, next year, but not so much in the long term. I think the model is probably most useful for early-stage ventures than more mature business models. Any views? Again, very good question. I'd say this is most useful for long-term investing. If you want to do next quarter investing, you should probably be using some sort of a machine learning model where it's really, really rich. It can take in a lot of different features that might be available, but it's doing this very narrow forecast of just what's going to happen in the next period. That is a perfect setting for machine learning. What these models are doing is it's saying, I don't just care, evaluation is not just about the next period. It's about longer horizons than that. Now, maybe you might feel a little bit uncomfortable extending your horizon out 10, 20 years. But for one, again, as I mentioned before, anyone who's doing traditional corporate valuation is doing exactly the same thing. They're making a forecast over the long term. And it might make you uncomfortable, but that doesn't mean that that's not how you value a firm. So we would rather choose to kind of confront that reality head on and deal with it than to, again, kind of bury our head in the sand. That being said, one thing that value investors will commonly do is they'll forecast what's going to happen over the next 5, 10 years, and then they'll assume some sort of a terminal growth rate. If you wanted to, we wouldn't necessarily recommend it, but you certainly could do that too. So use a model like this, use that to make your projection over the next 5, 10 years, and then use the same sort of terminal growth assumption that you would have used had you just used the traditional corporate valuation approach. So again, I think there's this underlying theme in some of these questions of, is your model going to provide perfect estimates? And again, I think the enemy of better is perfect. So we would rather aim to do something better instead of trying to wait forever for some perfect solution that may never come about. In terms of early versus late stage, it's a very good question. Your intuition is correct that I'd say the sweet spot is somewhere in the middle. If a firm has been around for only, call it 1 year, we can certainly compute customer lifetime valuations, but those customers may be very different in terms of their goodness from the customers that same firm will acquire 4, 5, 6 years from then. And the business itself is going to be much more likely to make a severe pivot that could also alter the goodness of customers. So what we found in our previous academic work is that as long as the firm has been around for, call it 3 years, we can have more confidence that we can predict well at least over the next 2 years. Now, for most companies, 2 years is an eternity. So I think that general rule of thumb should hold. Does the model apply to mature businesses? Most definitely, yes. You have so much data that you can really learn a lot about the goodness of customers. That can be super useful, especially for tactical customer management decision making. But you're right that once the firm has been around for 50 years, it becomes a bit more predictable. So again, that sweet spot is probably where you can extract the most value from this methodology. But I still think that this would be incremental, even if you had more data. Given that you don't stick your head in the sand, it's supposed to have some dynamic variables which are true. Is your model more responsive to firm value in short-term scenarios? It depends. So in the example of Farfetch, again, if we just kind of look back at that gross margin chart, up until the time of the F1, their gross margin had been pretty steady at around 51%. It hadn't really changed for many years. And then we saw this kind of precipitous drop in their gross margin to 46% in a single quarter. Would we adjust our kind of margin assumptions to account for that? Most definitely, yes. But there's other situations where essentially you're inevitably going to have some noise in your data, that you have a quarter where acquisitions are somewhat weak. But if we infer that the overall pattern is pretty much the same as what we've seen, then we actually will react less than some other models might, because we would kind of fade that and say, yeah, I see that we came in lower, but statistically speaking, this is what we would expect. We would expect noise, and that noise falls within the range that we would have predicted. So we're going to still kind of look at all of that historical data and use that to base our kind of stabilized prediction. Does the valuation of a firm change so much when it has experienced a drop in the number of customers, even though their revenues have increased a lot? So if revenues are going up, but the customers are going down, then mathematically the only way that would happen is if the amount of revenue that the company is getting from all the customers that are remaining is skyrocketing. Sometimes you do see that. It's most common in B2B settings, like companies like Shopify. They've been hitting new highs lately. And what's interesting is they acquire a bunch of customers, and a lot of them will drop out. But if you look at their cohort curves, the value of the customers who stay expands significantly over time. So net, they're actually earning more revenue from their customers. They're having revenue growth within a cohort, even though the number of customers is going down, kind of like you're describing. So in settings like that, our models would be very useful because we can actually be able to say, this is where the source of value is coming from, and thus have more accurate projections of what future revenue and valuation are going to be. Does that change the valuation of the firm? Well, it would change our assessment of how good the firm is. Hopefully that makes sense, and please follow up if you had a follow-up question to that. And I see we just have a couple more. I know we're at time, but you're happy to kind of take these last couple, and then maybe if anyone else has any questions, you're very happy to take those questions through email or otherwise. Would you give an example of a well-known public enterprise which would be ideal to implement this customer evaluation procedure? Any very high growth company that there's questions about the underlying unit economics of the firm. A company like that, they may have some view as to what their unit economics look like. We would claim that our models are probably going to help definitively answer that question for them better than they could. But I think the fact that they have a lot of potential investors who may be questioning their unit economics, you'd really want to go in and make sure that you're making that case very carefully. So to be able to prove it in some very rigorous way using a methodology that's highly validated, that could actually bring about valuation expansion, because it's essentially removing that source of confusion from those prospective investors. Companies seem to focus on customer acquisition but falter on customer retention. Agreed. In general, what assumptions are you making in terms of customer retention strategies for LTV? I'd say the main assumption that we'd be making is that essentially the way that the company has been managing its customer base in recent periods is at least somewhat reflective of where we're going for those future cohorts. So it's not saying that we'd expect their kind of behavior to be static, that there's going to be no improvement or even no deterioration in retention in the future. But rather it's that the trends are going to generally remain the same. So obviously every year companies hopefully are improving. They've got procedures in place that will make next year better than this year. We'll be able to infer that through our model. And so basically what we would say is we're going to expect that the company will continue to have that sort of improvement in the future. That being said, if there's anything kind of one-off in nature that we do happen to see in current periods or in historical periods, we're going to most certainly account for those so they don't throw off that forward-looking projection. So I think hopefully that addresses all the questions. Certainly again, we'd love to hear from you. Please connect with Pete and I. Please connect with Joshua if you think this sort of methodology could be useful to your firm or to firms that you're considering investing in. So that's pretty much all I have. Thank you so much for having us.
Okay, thank you. Thank you very much, Daniel, Peter, and Joshua. It has been really interesting presentation. I mean, we learn new ways, innovative ways of dealing with corporate evaluation, and I think this is super interesting, something that we haven't seen before. So thank you so much for sharing your work with us. For the rest of you, thank you for participating. If you have any question for Peter, Dan, or Joshua, just feel free to send them directly. If you want to send the questions through us as well, you have in our website the email. So that's it. Thanks again, Peter, Daniel, and Joshua. And well, stay in touch for next webinar, everyone. Thank you very much for joining.
Great. Thank you very much.
Bye. Thank you.
Take care. Have a good night.
Thanks.